This would really ultimately go down to the narrative that Donald Trump effectively sees, like Steve Bannon, a window in order to curtail China and stop China from actually becoming the #1 world power. That's what you're talking about here,
Absolutely.
really.
Good morning, Rashad. Absolutely. And that's hit the nail right on the head. 2018 is about US and China and nothing else. And it's really exciting from a market's point of view because reality is now going to be reflected across markets, unlike 2017, which was the Goldilocks scenario, which wasn't really reflecting anything but an extension of QE.
So what happens next? That's the question.
From a political point of view, it's brilliant. From Trump's point of view, he's found the next topic to push him towards the 2020 presidential elections for himself as an individual. For America and China, obviously, it's only the beginning of who is going to have hegemonic power going forward. And we're seeing that reflected in markets, and that's a very good thing. Volatility is a good thing when it's reflecting what's actually happening in politics and what's happening in the real economy.
Stirling, no doubt it makes our jobs, a lot more interesting. 2018 has proven to be really interesting. But as an investor, how do you position yourself, given there's so many unknowns? And there's firmly two camps. One that's saying, let's not get ahead of ourselves and take this trade tussle too seriously because a lot of it's just going to be just talk. And another camp saying we need to be a bit more cautious.
That's a really good question. Why it's important is what we're seeing since 2014 is what's called hyperconvergence, that markets and asset classes are coming together. In the S&P 500, in the US market, 55% of all the gains from year to date, as in 2018, were in 4 names: Amazon, Nvidia, Microsoft. And why that's important is it's time to see some volatility and some differentiation. And that's good for investors because then they can have a reflection about where they believe markets are going and affect their portfolios accordingly.
Well, perhaps, if you look at the two sides and you look first at the Chinese reaction, they can sort of not engage in a reasonably measured way, which I think is what we've seen, or they can go nuclear. So, tap into their holdings of US Treasuries, do something alongside the currency. What's most likely in your view?
China's been playing this game for 30 years, and what's happening at the moment is obviously it's making headlines, but China's been playing the same consistent game, and you would say that they're playing the Chinese game Go. They're playing a strategic game, and that's what we saw with the Chinese government bonds actually performing better than the 10-year treasuries in the US as of the first quarter 2018. That alone is a very interesting fact that has implications for all markets, but particularly the relationship with America and China.
Sterling, there is the nuclear option, as they put it, and I think that Heidi was alluding to that. They could start selling treasury bills, but they don't want to see their own reserves being completely, more than decimated, because they've already reduced by a tenth.
Absolutely. If China starts a trade war with the US directly, that's one thing. What China really doesn't want is Europe, Australia, Canada, and the developed democratic world, and of course Japan as well, taking on China directly. So what they would never move to that option so quickly because obviously that broadens the battle for China, and that's not in China's interest at all, and everyone knows that. It's
interesting you brought Japan in. Where is Japan with all this? Because we did have, of course, them not being exempted from those steel and aluminium tariffs as had been broadly expected, and everybody thought that Abe and Trump were golf buddies.
Exactly. And I guess that goes to the analogy we used a few moments ago. China's playing Go and America's playing throwing darts at a board. And to answer that question directly, Japan should have been excluded from that logic. But as we know, the Trump administration doesn't really believe in logic. But what it does mean is that Japan is playing a really interesting role for investors to watch because Japan has, since 1983, been the middle ground of volatility between emerging markets, in this case that means China, and developed markets. And of course, that still means the US.
Well, I note that in your notes, Sterling, you say there's no compelling reason why the yen should be ripping higher. I'm not so sure about that because you can either look at it as being the greatest beneficiary of volatility or of geopolitical tensions or being the greatest victim, right, if you're talking about Abenomics. What's your call as to how much this currency is going to strengthen before we see some intervention going on?
Sure. I guess to put that comment into context is since, again, 2015, there's been what's called the Shanghai Agreement, similar to the Plaza Accord in 1987, where central banks came together and tried to keep volatility out of currency markets to a minimum. What that comment is referring to is Japan has been, and Europe, of course, has been very unhappy with what mentioned etc., have been commenting on in recent times at Davos, etc., and there's a discord between that. Just to flash back to the to the Plaza Accord of 87, the second that broke, we saw the 1987 stock market crash. The Dow Jones moved by 27% in a single move on the Monday after Treasury Secretary at the time, Baker, was disgruntled with the Bundesbank in Germany. So there's some direct parallels at the moment, and I guess that's what we're going to with regards to the Japanese yen.
It doesn't seem like we're going to get anything like a Plaza Accord now. It seems far too difficult to do something like that.
We don't get 27%.
Precisely. What about you? How do you then manage your money? It's not the time to be a passive investor, I'm assuming.
No. And I guess remember the context as well. We're in the longest US expansion in human history. We've seen convergence and hyperconvergence at the moment. And it simply boils down to, do people believe there's more upside in markets? If not, and we think that the business cycle itself is coming into a downturn or possibly a recessionary stage, where do we move our money to there? And it's really that simple.
And very quickly, where do you move your money?
In that scenario, you move to cash if you're believing we're moving to recessionary times. But again, it's very early to make that call.
Right, so you're not positive on equities?
Again, not in the current daylight, no. But things change and you have to participate in markets and keep on the edge.